You remember the Jazzercise?
The Jazzercise.
Back in the day.
What's that guy's name?
Let's get our little theme music going. Here we's a poppin'. I know this is your beat, Casey.
Yeah, there it is. Wait.
Ooh, he's bringing the pop, even though we're all together. Ladies and gentlemen, little dance. I like it.
That's really the only move I got. Sorry, guys.
Probably one of our most impressive intros right there. I'll take that. Good afternoon, ladies and gentlemen. So, boom, we got the whole MLO team together here today. Extremely excited to dive into a very special topic, everybody. I'm talking about shopping your lender.
Shopping your lender.
Right, boys?
That's right.
So what does that mean right off the bat? Shopping your lenders. How do we get the best actual terms on our mortgage? So if you're going out there looking to refinance, purchase a new home, you might even be selling them, buying another one. Everyone wonders, are they getting a good deal? And one of the issues is these estimates, guys. I mean, we do this for our profession, and they still are confusing to navigate. The way they're structured, the different pieces, the closing costs, the differentials. So today we're going to dive into tips and tricks to understand your loan estimates that you're getting from different lenders, because we've learned that the lowest rate doesn't always mean the best deal, right, guys?
That's correct.
Very true.
Boom, 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 boom. So just to kick it off, I think we want to go into defining what shopping your rate is. Like, CK, you've been doing this for so long now. Talk to us a little bit about shopping. You might be considering a refinance, or you get all that junk mail, right? So what do we do with it? What does it mean when I get something in the mail? Take it away.
Certainly. So we're being inundated daily right now through Facebook, social media, even in our mail. We're getting things from even our current lenders, or it says our current lender open from your lender. A lot of that is just advertisement coming in. They're getting things off the title and just kind of seeing what your last loan was at. They know some general information, what your current interest rate is, and maybe some of your debt load. So they're saying we can do a debt consolidation with 30,000. So it's just general stuff. Now, the lending trees out there and everybody out there that are throwing out some of these numbers, 2.99 on a 15-year, 3.375. Those are probably pretty standard, and they're putting some caution behind that with maybe 1 point origination. You hear real fast talking and whatnot. So there's a lot of different. Yeah.
A lot of words at the end and real fast talking.
Yeah. So we kind of got to just go back to A, B's, and C's. And so we had a change into our disclosures a few years back. And so now we can really, as a consumer, see what exactly your rate is by APR. So APR is a big thing. So you can see any kind of fees that have been kind of pushed in there that you don't see in black and white.
So I want to bring that. Yeah. I want to bring that back. I keep toggling over to Casey on the mic, but he's not talking. So my apologies to everyone watching. This is a live studio recording. So really, really good point, CK. Interest rate versus APR, huge difference, because the interest rate that you get does not associate a figure to the cost. So you'll see two different interest rates, the one you get for the note and then an APR expressed. So that APR figure, which is going to be hopefully just slightly higher than the note rate, is a true determiner of what you as a consumer has actually invested to get the terms associated. So I just wanted to, I'm sorry to cut you off there, but just like point. Super good point, right? I mean,
and I want to touch on that too, because like what Christian was talking about, I received one of these fantastic looking offers in the mail. And, I'm in the business, but, the rate advertised on this piece of paper looked good. The kind of program they were talking about kind of fit what I was looking at. Was actually a veteran, a VA home loan advertisement for me. So I called this lender and I actually thought, and this might be a lot of consumers out there, I actually thought this letter had come from my existing lender because it had their name at the top of it. But what I didn't realize till after I had called the number and got on the phone with someone, that it was just another lender sending me this advertisement and then had my current lender's name at the top, basically saying, hey, your loan is with this, but we're going to try to offer you something better. So I called, and basically just right out of the gate, I just was honest. I said, hey, your rate that you're advertising on this piece of paper I got in the mail looks fantastic. The program sounds great. What do I need to do? And it was right out of the gate. The lender just told me, yeah, that's just a marketing piece. And your situation probably pertains not to this piece of paper.
So we'll have to look at it. Called the competitor.
I called the competitor because I wanted to know what this great rate and program was about. Honestly, I wanted to know, maybe it might be something I take advantage of myself, or maybe in my back of my mind, I was thinking maybe it could be something I use with my clients, or how are they structuring this? At the end of the day, it was none of that. It was just a piece of paper to get me to call them, and the terms then that we started going over were nothing that was on that paper. So
wow, that's
some of those things are, situations where as a consumer, you're getting, inundated with just advertisements and marketing with low rates out there. But it's not exactly what what you're seeing on those papers is not necessarily what you might get.
So a couple quick things too, because we're talking, there's a ton of, and these guys get frustrated with me because I always say we got to put the compliance layer and be very, very clear. Like, the rate associated, there's so many different factors. And we were talking about this when we were doing our last episode about credit. There's so many different factors that are associated to what interest rate you get. And they're not only different per lender, but loan product, house type. So there's a lot of different players. So just because you get something in the mail, that's the first point, doesn't mean. The analogy I use is like, at least I see all the time, have this Mercedes for $199 a month. You'll be driving the C-Class Mercedes. I have yet to meet an individual that is paying $199 a month for that C-Class. They usually drive off. It's like they show up at the car lot. They're all like, I want that $199 thing. And they're like, oh, that one's gone. That deal's off the table.
We call that the lost leader.
That one is out of here, guys.
Right.
Like that. But we have this other one at only. So that's the game they're playing. And I think, like, going back to what you really want to be able to do from a more serious standpoint is at least be able to dissect what you're looking at so that you can compare apples to apples. Because there might be, say, one loan estimate at 4.00 and then one loan estimate at 3.5. However, the 3.5 might be paying what's called discount points, or might be paying what's called an origination fee. So when you are looking through these, I always encourage my clients when they're like, hey, I've already been through the process. I didn't know I got whatever rate. I would say that's fantastic. How about you actually send over that loan estimate to me and I'll review it and we can go side by side. So taking that, I think it's really important to have a trusted mortgage advisor at least so that you can cross-reference. And hopefully he or she's trusted enough that you don't have to worry about that and you can explain things. I always like to reference kind of some national averages when I'm working through with my clients. And be straightforward from the process. But we'll dive in a little bit deeper to 2 points when you're looking at your loan estimate, which is like 3 or 4 really long pages broken up into different things. So one thing to know is costs associated with the loan, and then also escrow deposits if you have. There are prepaid insurance and property taxes associated. So usually loan officers are going to use closing costs as a combined closing costs and your prepaid escrow into one figure. And there's different ways, unless you're specifically focusing on one property, for a loan officer to give an inaccurate or skewed estimate to you. So the apples to apples piece is super important. And going like, I want to bring this over to CK. You've seen this so much. Like, talk to me about discount points as well as
100%
origination. Hit me with that.
Well, I got an example, just one that we have going like this month, where a client, they were online and, we were talking, me and him were getting ready to refinance again. So he pushed the button, he saw an amazing rate.
Yeah. And
so he went through the process and it was an application. So he got some disclosure. He requested a rate 3.25. So that came back with an origination of the lender's fees, which was I think $9.95 and $5.40, and then it had what they called a discount point, and a discount point was a fee, a one-time fee to buy the rate down to that 3.25. So obviously that lender on that day had a par rate, which cost the client zero, at a higher rate. Let's say, for example, just for this purposes, that rate was, 4%. Okay. So he had to charge my client on this $300,000 loan 2 points discount to get that. So my client got his disclosure. He's happy about this rate. But when he sent it over to me, I was like, okay, did you see that it's costing you $18,000 with your prepaids to do this loan? He's like, yeah, I thought that was kind of high. So yes, the rate was fantastic. It was the payment he wanted. But when he looked at mine side by side, apples to apples, guess what? My loan amount was $5,000 less to get the exact same thing because it was a less of a discount point. So it's lender to lender. And a lot of those call centers out there or internet servicers, they're just getting the next. So when we have these relationships with our clients that come back to us year after year and their family are recommending them, we sit down with them and make sure that, they're going to get the best deal possible, because obviously that's a big difference. $5,000, was a huge difference in that loan. And ultimately our payment was lower and the client was happy, and we're closing next week. So
yeah, so so going back to a couple points that CK just made there, because it's really important for people who don't talk about this all the day. Maybe you're a first-time home buyer, or maybe you just don't care and you've just done whatever people have told you to do. Right. Couple terms I wanted to hit. Case was that make you come up right there?
You just do whatever you want to do nowadays.
The discount points, because I think we do need to define that so that our listeners and our audience, I get this question all the time. I'll get people that ring me up and be like, what are your rates at today? I'm like, hey, nice to meet you. What did you say your name was? So first of all, discount point is an additional charge on your closing costs to obtain the rate that is being offered to you. So typically the lower the rate, the higher the discount point is, because you're getting a better deal. You're prepaying the interest on it to bring down the rate, which consequently lowers your monthly payment. Now, when you hear somebody say, what is par? Because you'll hear that all the time. I liked it when CK went into his fast talking. Like, we're 4% par rate or whatever. Par means they're not actually charging you any additional costs for that rate. So it's a big thing if you're a consumer and you're talking to a mortgage advisor to actually be like, okay, so what are your rates today? They're 3.375. Is that your par rate, or are you charging me points for that rate? And another thing is, and this might be really confusing, is when you say, you might have, say, a mortgage advisor say, I'll give you X rate at a charge of 1 point. Most people don't even know what that means. 1 point means 1% of the amount borrowed. So if your loan amount's $300,000, they're going to charge you an additional $3,000 for that rate. And another confusing, if you even get that far down the road with mortgage, people think that $3,000 is your closing costs, but it's not. It's on top of it. It's like, it's just, I'm really passionate about doing everything that I can to explain to our consumers what these are. I want to dive in. That's discount points. And what's another deal that because I know you were trying to chime in on.
Yeah. And one thing too, I wanted to just touch on too, like CK was explaining. I mean, that's the beauty of having a relationship with a loan officer that you trust, is those conversations are easy for us to have with our clients. It's like, hey, client, that's great. You're getting offered, a fantastic rate from ABC lender. What our clients, will do in most cases is we ask to see, what that quote is, so we can look at it side by side and walk them through to show any differences, any discrepancies where, they're charging, extra discount points, or where you're paying more compared to the lenders, and what we're just trying to do. And there's sometimes, guys out there's sometimes where maybe the deal is a better deal for that client to take than what we have to offer. And we are okay with saying, hey, this is a great deal. We've looked at it with you. We've looked at everything, and it might be one you need to just consider and go with. That's okay in this world to help your client, make the right educated decision. That's what loan officers should do. But what we're trying to kind of reiterate the fact is, as that client and you're shopping around and you have a good relationship with your loan advisor, bring to him your questions, bring to him those other offers, maybe the other lenders have given you, so you guys can look at it and review. Because in the end of the day, in most cases, what's being told to you guys verbally, probably from another lender, is not usually the case when it's on paper. So it's a huge point.
That's a good point. I do want to break into the discussion. It's like, why do some lenders not explain some of this stuff? It's just mind blowing to me. Like if a consumer came to me and really wanted to know, hey, what are these costs? I think there's a huge breakdown, especially with how confusing the loan estimate. I keep using my hands for all the people that are just listening. I keep making this like exaggerated vision of the loan estimate. So when you get one, it breaks down all these different quadrants, and that very first quadrant of your loan estimate actually is loan associated costs. And I want to like bring in a little more serious there. That first section is extremely important because they're essential non-variables. So the other sections, such as prepaid escrows, estimated insurance costs, appraisal fees, all those things, title and escrow, all those things cannot really truly be determined until you are in contract on a home and for sure are moving forward. So your really only strong review on an estimate would be that first section of where your direct lender costs are. And that includes most often an underwriting and processing fee that's typically flat. Now, the other ones you want to look for is that overly explained earlier, the discount points. And then CK and I were talking earlier, there's a new trend that we're seeing some mortgage advisors demonstrate what's called an origination fee, which CK, this has like that phased out for a really long time, didn't it? But now we're like back. I'm hearing people doing them.
Yes. I'm hearing some different lending institutions bringing the origination fee back. And what that is to help them do is derive some marketing, I think, with a low interest rate, because they're putting in that speed talk at the end, 1 point origination, APR, blah, blah, blah. So yes, my job out there is to meet with my client individually as an advisor and not just rap out a number to them, because I'm doing them a disfavor, because I don't know what their credit score is yet. I don't know the property, loan to value, all those different factors that deeply play within that amount of APR that we talked about. I want to kind of bring this conversation back to the APR, because that is the whole goal of this episode, is shopping, your rate. And you cannot excuse your APR being up, a percentage point from that 3.375 and your APR is 4.75. We know there's a discrepancy there. There's fees that are associated with this loan that are in there that you're not seeing. So apples to apples, huge, matching the APR, not the note rate, the APR. That's
a really good point, because one of the things I see most commonly is like, say you're at a family gathering and brother A, B, and C. Brother A says, I got 4%. Brother B is like, I got 4.5%. And then brother C just says like, I got 3.7. But none of them remember what? The APR.
Yeah, exactly.
Nobody remembers what they actually paid. And that is the actual true thing to analyze. So when you're backyard buddying, like, the APR is what matters. So that's a really easy thing to a takeaway, guys, just to bring this back to takeaways for the consumers, because that's what this is for, a transparent space for home buyers, sellers, industry partners alike to go ahead and learn takeaway bullets that can impact the experience for our consumers and set them on the right track. Remember note rate and APR and compare them. Secondly, I would put in, I want to bring this in, the difference between loan products, guys, because you're going to see diverse note rates and APR rates from, say, a conventional loan to, say, an FHA loan, a government loan, because there are some fees associated with the government loans in some cases. Some are alleviated from those costs, such as our veterans and VA loans that are on disability. They are alleviated from those. But one of the huge misperceptions is I'll hear more stories of mortgage advisors being like, oh, let's just get you into an FHA loan because the rate's much lower. But they don't explain that FHA has what, 1.75% funding fee, correct?
Correct.
Associated with the product, which gets rolled into the loan, decreases the interest rate, but you're forfeiting a roundup of 2% equity before you even move into the house.
And that's why you see the APR so much higher on an FHA loan.
That's what I was moving to.
And it's because they're looking at that from a holistical side of what the cost is and what the true APR is. Because that's being financed in there. Anything that's being financed into the loan or costs that you cannot shop for are going to be calculated in that APR.
Yeah, the hard cost.
Yeah, and I like it because in just a very generic layman terms, it's the cost of your loan reflected as an interest rate.
Yeah,
simple as that. Yeah,
there it is. I mean, you can look at that and know, hey, this 3.75 note rate that I pay my payment based off of is great, but my 5% APR is basically telling me I might have a high cost loan here, and maybe I need to shop it around.
You know, what's funny is when I get a cost worksheet or a CD come over and a client wants me to shop it for them, what do you think I look at first thing? I look at the APR. I want to see where my room is or where their pricing this thing is. And that tells me I got to look into this a little bit deeper, you know. I think most lending institutions, you know, as far as the total costs are going to be the same. I think it's the grid of the pricing. That's the greatest difference between, you know, bank A and bank B. And that's going to depend on, you know, so many back end things. Do they have a line of credit? Are they funding their own loans? Are they doing this? So unfortunately, as a consumer, you got to kind of shop the company that you're getting this thing originated from, because that's really, you know, what's driving your rate down. Back to your brother story, you know, A, B, and C that might have a rate of 4%, you know, 3.5 and 3.75. That 4% might be a lower payment because there weren't all those costs. It's a lower mortgage amount because they took a lower cost loan. Maybe it was $150,000 loan. You know what the difference in an eighth of a point is? It's like $17 a month. You know, you got to think about it as a 30-year fixed loan. You know, my compliance, I didn't do all the math, but
sure.
But that's the truth. So my job as an advisor is to be like, you know what? Based off of you telling me you're going to be here for 3 to 4 years in this house, maybe we take this 4% and not buy down the rate to 3.5 because we're going to be selling it down the road. Let's put that into the next forever home. And that's when you want to buy down the rate, you know? So it's different for every situation.
Well, and hopping in too, like buying down the rate is not necessarily a bad deal. It's like, because if you're spending money to lower the rate, in terms, your monthly payment's going to lower. So your mortgage advisor is typically going to assist you with breaking down what is referred to as the break-even point.
That's right.
So if you're, you know, spending money and you're going to save money for X amount of months, you want to at least be in the property for a minimum of that break-even point. So your mortgage advisor should assist you with doing that. And I want to make it clear, there's nothing wrong with buying points down. You just want to be comparing apples to apples and make sure that purchasing those points down for a lower rate does make sense. Generally speaking, Casey, when you are, say you have, you know, you're buying the rate down a little bit and the break-even point's 3 years, you want to make sure that you're likely going to be in that house for at least 3 years.
Yeah, and I think that's a huge point, because us as advisors, I mean, we're here to advise. So something that I know, you know, Addie and CK do, I do as well, is I'll sometimes give that client, if they want to see it, I'll give them the range. We'll start at, you know, an interest rate where they're kind of landing at for their scenario and credit score and stuff. And then I show them what that next one is and how much that cost is, and maybe a couple options. So they got 3 options in front of them. And I explain what that break even is. Here's the cost for that next rate going down. What's the savings between your initial rate where we're at and what it would look like, maybe buying the rate down a little bit. It's an easy math, but you can show that client exactly where their break even is. And the biggest thing to know is, how long are you planning to stay in this home? I mean, let's be honest here, guys. People aren't keeping a loan for 30 years. I mean, that was our grandma's at 15% interest rate on an $80,000 loan. They kept it for 30 years. That's not the case anymore. We see loans last 5 to 8 years, maybe. I mean, you have so many things that go into it. You pop a brand new baby out, you got to move. CK, you got to change schools for your kids. The economy changes. There's so many factors that play into that 30-year decision that honestly, it just doesn't last that long. So a break even is a huge thing. If you're, let's just say, buying a rate down and the break even's 5 years, but you sell the house in 3 years, you just spent money for no reason because you didn't ever see it through to see the savings. Well, so it's a huge deal.
That's a super good point. And I also want to reiterate too, I think that's what I like most about working with local people, not just mortgages, but with financial advisors, purchasing other services, is you do get that experience of someone who actually cares. And the first conversation, at least how I structure my business, is I call it an introduction call. People are like, what do you mean an introduction call? It's like, well, usually I like to get to know you as a person, right? And hear about where you're at in your life. What are your top priorities and needs as a family? What do you want to accomplish in terms of, is this a stepping stone house? You made the point with having a baby. There's just so many different variables. And without really truly getting to know a consumer, how can we assist with making the right decision? And I think that might be, and I'm not trying to get corny all of a sudden, but like, that's, Christian, when you say that's like a really big deal versus maybe someone that's dialing a bunch of 1-800 numbers and just trying to get quotes, because these people who are just picking up phones in cubicles, they're not taking time to get to know you. How are they going to advise you on your best decision if they don't know your history and your goals and your current?
Yeah, I really don't understand that you would want to just pick up a phone call and just say, hey, I want this rate, I want this terms, without really dissecting long term. Because I've been doing this for, like we said, 15, 16, 18 years. I can't remember where I'm at right now. But I can tell you, most of my clients, we always think this is going to be my last refi. Well, guess what? Equity goes up. You can tap into that number one thing that you have, and at the lowest interest. I mean, rates have been low since 2003. I would say, where we were taking people from 8 to 6%, and now we're down in the mid threes, low threes, and guess what? That's like free money out there. So people still tap in all the time. So most of my clients will come in at the par rates because we're giving them a great rate at that par rate. Now, I do have those clients that are like, this is my forever home. I just want to do this one more time, Christian. This is, our third refinance with you. I want to do the 15-year. I want a strategy. I pay this thing off in 10, and we're sitting down and we're really getting into the meat and the potatoes. But, so that's why, every situation is different. Every situation is different. And that's why it's so important to sit down with your advisor and really talk to them. Most of my clients, I know more about their financial background than their own wife does or their husband does, because I've dug in deep and had those conversations with them. Or we sit down together with a blended family where we're really diving in the deep into the income and debts and everything else. And we throw it on the table. So yeah, it's a vulnerable situation to sit down with your loan officer and really say, hey, these are my goals, or these are my troubles. How can you help me? But that's what we're here for. This is, what gets us up in the morning and gets us excited, is to go in there and help people day in, day out, and use our expertise in their years of these challenging times that we've seen and ups and downs. But one thing there is you got that asset. It keeps going up in equity. As rates keep on coming down, we're going to be here for you to make some decisions, and hopefully you choose one of our MLO teams.
Well, no, sorry, I know you're trying to hop in there. I think one of the important things too with that personal relationship is, one example, I had a client call me. I had done a purchase for them and a refinance in my career. Called me and was like, hey, Addie, I'm getting up. And I actually love it when like phone people try to refinance or call and pitch my clients, because then they call me and like, oh, great, awesome, I get to talk to so and so today. I've been meaning to catch up with them. Like, it just makes my phone ring for me, and calling me back. Okay, oh well, and I just ask them questions like, well, what are they asking? Like, what are they offering? Okay, did they say how many points? No. Did they say, well, no, that all sounds about right, but I know their whole history. It's like, well, so and so, like, how is your credit doing? Because I know that was something that we were working on the quarter 3 and 4 of this year. It's like, well, it's kind of here. Well, is that a credit card utilization ratio? Yeah, it is. Well, do you plan to pay that down? Yes, in the next 30 to 60 days. Well, look, I think our best move is to really slide you from, say, 680 up to that 740, which I know you can do based on our credit strategy, which would actually make your rate even better. And I feel confident. I don't have a magic ball, but I feel like confident that rates are going to be steady. There's no reason to rush into this right now. That takes business out of my pocket, but into my growth network for the long run. And you will not get that from a 1-800 person.
That's right.
They are trying to sell you and close you. I've done it myself. You said you called that competitor.
I called it.
I've called them and they've tried to close me.
Yeah, I know.
And it's like, why, if you have a professional whom is saying, hey, let's pump the brakes, let's look at this as a big picture thing, then that's just the key. And I know, Casey, that is your style with your clients.
Yeah, and it's funny too, because as I was getting pitched, I know my finances. I know, where I might have pain points in my loan and stuff like that. And as this guy's just telling me, yeah, you're all good. Oh, you got this, because I was giving him some information. I knew exactly where I was going to have hangups. Obviously, I do this for a living, so I know my own finances and where that's going to come into, some definitely maybe bumps in the road on a loan process. But this guy didn't ask me any questions about that. It wasn't anything about that. It's all about, getting that deal in and closing. There's no, what's your future look like, Casey? What are we planning for? Maybe this loan isn't the best loan, Casey. Maybe you're a vet, you need a VA loan, whatever it is, right?
Mm-hmm.
You need to know your client and educate and advise them, because it's not just, we're not just buying groceries and then we're done with it. This is a purchase that has, can have a 30-year effect on your life, right? And so it's also a tool. People forget a mortgage is a financial tool that you can use. As CK mentioned, later on, you tap into the equity, get another home. Now you're building wealth, long-term wealth. You're holding financial assets, and you're using a mortgage that you started with at the very beginning as your tool to grow yourself, wealth-wise. The last part too that I want to touch on is, besides looking at the interest rates, besides looking at, closing costs and stuff like that, those different loan programs sometimes require different costs to be in there. Let's say it's new construction. So when we're going through that with clients, we're also making sure that these other quotes maybe that they're getting from other lenders, we're pointing out the fact that they don't have early issue fees in there and fees that have to be in there for certain programs that other lenders will not have on there. They're going to probably be an extra $1,500 or so on your closing costs. They have to be there for new construction, or, other programs require certain fees as well to be there. And that stuff we're all looking at, because we've seen it and we know it. And we're going to tell that client, hey, this is missing and that's missing and this needs to be there. All coming back to having a relationship with your client and being just an advisor. We're not here to just sell. We're here to advise and educate.
Yeah, that's a really good point. With the hidden fee with the new construction, there's a lot going on a new construction.
I just wanted to ask you, Addison, how many times have you got that client right at the end where they've already made an offer, they had a pre-qual letter with another company, that relationship fell through, and all of a sudden you're getting it and you're short funds to close because maybe they didn't have the right taxes in there. They didn't tell them that seller, you got to pay the seller some taxes, the prorations and everything else. We're talking $2,000-$3,000 short when they're coming down to the table, or 2 weeks before, and we're having to call parents and everybody else. And that comes back to the mortgage advisor, because we're going to tell you all those things, that every property is different and we need a pad of this. I'm not going to, maybe they didn't even look at your banking statements yet to look at, your source down payment. So back to just not taking somebody off the streets, get a referral.
I think that is a really good point, guys. And I want to bring that up again with a Christian just put together there, being short cash to close. So when you're looking out and talking to a bunch of different companies, there are ways to present loan estimates that might look like they are less cost, but they aren't truthful and accurate. So the absolute, and it's hard for me as a mortgage advisor, it's not hard, but I have stick to guns of being as accurate, if not overestimating the costs when it comes to the escrow and the taxes, the prepaid, all the ones that I don't control. And the reason why is exactly what Christian just said, is the worst nightmare is going to the closing table and not having the accurate cash to close or enough money at all because of improper due diligence. And I can, assure you that many people that might not be local or might not have any sort of tie to the community of where you're buying real estate, they just won't care. Another really good example, I had this one happen. Someone introduced me as a new client. I was like, great. I did my no pressure situation. I was like, hey, I'm here as a resource. I could work with this team. We never force you to, use me, but I'm here as a resource. And like, yeah, we went through the whole pre-approval process with a guy that we had met on, like, I think it was a vacation trip or whatever, and he's going to hook us up. And okay, no, that's great. And I never pressure anyone. I support all of the agents in this community 100%. Here's a resource. And what had happened was they went with this guy, they got in contract. 2 weeks went by in contract, they get a call. The person that was, quote, giving the deal wasn't even licensed in the state. Right. Wasn't even licensed. The file hadn't been touched for 2 weeks. Now they're looking at extensions. He had to go broker it out to another person. So they're 2 weeks behind. Who knows who, like, now just the deal doesn't matter. The homie hookup doesn't, like,
but it was a homie hookup,
which is just, there's no,
over some cocktails.
it just doesn't happen. So, like, how devastating would that be? And people, that goes back to if that person truly cared, did an introduction call, was involved in the process and the main goals, there's no way someone with a heart would, like, how did you even write a pre-approval letter for a state you're not licensed in?
Right. And it's just, it hurts us guys out there. I mean, you never want to see someone making one of the biggest purchases of their life have the thing come crashing down at the end.
Uh-huh.
I mean, it's awful. You never want to see that. And all it takes is that loan officer to talk about the process up front, learn about that client, know what direction their life is going in, to try to put them in the best financial mortgage tool for them to use, or mortgage product. It's just key, guys. I mean, it really is. And we can't say it enough, because especially the local stuff, because I mean, we're here in it. At least we're in this community with you. We buy houses in this community. We have tons of, real estate partners that do the same and help people buy. So, I mean, if anything, it's just the experience and the advice is worth just your ear for a couple minutes to listen.
Yeah. I think you're just spot on. And that's an underlying factor of the local that we didn't bring it up. I mean, just to put it in kind of an easier term, is like, it's so easy for someone who has zero ties to the community and the city, and no one could ever drive to their office or their address to confront them if they made an issue. Like that story back then is like that, they're never going to see that person again. So I want to kind of weigh in the plane on a high, if you will. Did you like what I did?
Yeah.
Bring it up. So let's summarize the benefits of today for shopping lenders, and at least maybe like breaking down the understanding basics. So we started right off the bat, and I loved this from Mr. CK Mortgage Guru here. The difference between your rate and the APR. Huge difference. You got to understand that the note rate doesn't necessarily matter. The APR is the one that associates all of the costs. So that's something you can look out for if you're going around, if you're at the backyard with your buddies and people are swinging, I got this.
2.75.
Oh yeah, 2.75. They charged you 10 grand for it, but at least you're the winner in the bocce ball in the backyard, right?
Yeah, you are.
So that was one. The next one was really looking at that section of lender related costs, that first section A on the loan estimate. Very, very important. That's where you're going to see changes. The next one, understand what par rate means, no additional costs, and discount points when you're buying down the rate, and all of those going on top of your flatline costs. So some real big takeaways there. Last but not least, the power of working with the local individuals who not only care and understand your big picture and the little tiny things about you, your family, your long-term strategy that can actually stop you from, saying yes to someone that's trying to just talk you into something. Lastly, help me out.
Knowing your programs, VA, new construction, what fees need to be there, and what you need to look out for are big, big, big ticket items as well.
Yeah, don't be fooled. Understand the loan product and that there are different associated fees with all those. CK, aka Kempers, anything to throw down there?
Yeah, if you're getting those cost worksheets or those estimates coming over, and then you're getting disclosures and they're totally different, well, that's usually some changing within the APR, or they've done a bait and switch. So let us look at it for you. We're here for you as your MLO advisors right here locally here in Portland, Oregon, licensed in both Oregon, Washington, and California. Are you still California?
We got a Cali.
That's right. So we're just here to support you and look at all those cost worksheets. We want to help out our community, be a resource out there, and have transparent numbers out there day in, day out, so that you're out there shopping with confidence.
Yeah. And I just, please, if anyone takes away, please take away those bullet points.
Yeah.
No versus APR. Understanding closing costs are changing. Look at that section A. Work with people that care and trust about the future of you and your family and are going to advise you not from a personal gain perspective, and you're going to be crushing out there. So if you ever need any help, we are always here to help and support, as like CK said, a transparent community here and an environment for home buyers, home sellers, industry professionals alike. This is AddieNet. These are the guys. MLO. Casey, thanks for being here.
Yes, sir.
And Mr. Kemp CK.
CK.
Boom. Till next time, everybody, we will catch you later. Little bobber.